Senator Hagan wants to say something briefly in that we have a witness from North Carolina.
Thank you, Mr. Chairman, and thank you for holding this role on the this hearing on the role of the secondary mortgage market for small financial institutions. As we look at ways to reform our housing finance system, it will be critical to understand the issues faced by small financial institutions and the communities that they serve. I would also like to thank the chairman for inviting Peter Skillern, the Executive Director of Community Reinvestment Association of North Carolina, to testify before the committee today. CRA-NC, as the association is known, is dedicated to promoting and protecting the community wealth in underserved areas. Since its creation in 1986, it's played a key role in regional advocacy and development for underserved areas. Mr. Skillern is a graduate of the Keenan Flagler School of Business at UNC Chapel Hill, came to work at CRA-NC after serving as the executive director of the Durham Affordable Housing Coalition. And under his guidance, CRA-NC has pioneered innovative outlets to promote financial education to residents in underserved areas. And this is something that I have championed for many years, especially during my time in the North Carolina General Assembly. And I look forward to his testimony and the deep knowledge he can bring to today's discussion on access to the secondary market for small financial institutions. Thank you, Mr. Chairman.
You proceed.
Thank you. Thank you very much, Chairman Johnson and other members, for allowing me to speak today on reforms in the secondary market. On September 6, 2000, I testified before the House Financial Institutions Subcommittee on Government-Sponsored Enterprises. And I stated, quote, "For the record, these high-cost loans will become a significant problem in the coming years. In the future, this committee will return to discuss how the financial markets played a role in spurring high default rates and the decline of our neighborhoods." That proved to be true. Subprime lending was bad for our neighborhoods and for our economy, and the purchase of those high-cost subprime loans was the primary cause of the GSE's failure. Today, I'm concerned that reform proposals that eliminate the GSEs and convert to a solely private capital market will also be harmful for our communities and housing sector as a whole. We support reforms to increase private mortgage capital with adequate oversight. However, the GSEs are needed as public purpose agencies that provide stability for our nation's housing and financial markets. We are concerned that megabanks will dominate the mortgage market from origination to securitization to the detriment of consumers and small banks. In the rural areas of Alabama, North Carolina, Oregon, Ohio, and South Dakota, megabanks originated 75% of conventional loans and 88% of FHA loans. By comparison, small institutions under $10 billion originated 16% of conventional loans. Small lenders shop their loans among the secondary buyers of GSEs and financial banks and financial banks. Loans are underwritten to a standard established by the GSEs and sold as commodities to those who are offering the best price and services. If the GSEs are eliminated, the secondary capital markets will become dominated by megabanks, which will further concentrate capital and a vertical integration of the mortgage market. This will disadvantage small lenders' access to capital, underwriting, and technology that is controlled by their competitors. If megabanks are too big to fail now, imagine their size, power, and vulnerability as they become guarantors and holders of the mortgage-backed security market. Capital is greedy and scared. Its volatility adds to swings during booms and busts. Private capital, as the primary source of liquidity, will not act countercyclically to provide credit in a recession or to slow things in a boom. By analogy, mortgage credit is like water. We are concerned about the quality of water that comes out of our tap. But we also want to know who controls the water's availability and its price. Who owns the plumbing from the water source of the glaciers to the spigot at home? Mortgage credit, like water, is too critical and should not be entirely controlled by private interests. But if we should not privatize the secondary market, what should be done? We believe that the GSE should be converted into public purpose entities that are accountable to Congress but are not a department of the government, such as the Federal Housing Administration. The agency would provide liquidity for 30-year mortgages that are explicitly guaranteed for priced adequately for reserves. The agency would provide liquidity for multifamily financing. The agency would act as a provider of underwriting standards and technology for the benefit of the whole market. It would balance private influence by providing choice on the secondary market. As an example, the North Carolina Housing Finance Agency is not a government department. It's independent, yet it serves a public purpose of financing affordable housing and rental. While appointed by the governor and state legislature, the board is independent, self-supporting, and operates without appropriations. Likewise, the GSEs can serve the public purpose in the secondary market for rental and homeownership financing. We concur that the status quo is not acceptable in the long term for a healthy secondary market. We support reforms that include reducing the portfolio of GSE loans and liabilities. They have grown too large, and the sale of assets can help to strengthen the capital base of the institutions. Pricing for explicit government guarantees on 30-year mortgages is needed. Reforming FHA to provide adequate infrastructure and oversight to its portfolios is part of a broad reform. We oppose the GSE's current loan level pricing program and recommend that it be amended to better utilize private mortgage insurance. This will lower FHA volume, yet increase lending to creditworthy households who have low down payments. The financial meltdown was caused in large part by private label mortgage-backed securities. Private institutions should be involved in mortgage securities, but on the condition they are recognized as systemic risk and have adequate oversight for safety and soundness. Let me state for the record, if the proposal to eliminate the GSE succeeds, this committee will meet in the future to address new problems. We will have more volatile capital markets, greater inequality in the access to mortgages, and disinvestment from low and moderate income communities. The real estate market will struggle as it becomes more difficult for renters to become first-time home buyers. Small lenders will be less competitive with megabanks. We will lack financing for affordable rental housing for our workforce. If mortgage financing is not inclusive of low and middle income families, we will have a system that works very well for some, but not for too many others, and ultimately not for the greater good. Our agency affirms the vision of an inclusive and healthy housing market. Thank you very much. The access to capital is not only about the money, it's about access to the technology and the business services that allow you to sell on the secondary market. One can imagine large lenders saying, if you'd like to have capital access through our channel, you'll need to adopt our business operations to do so in our underwriting. Trapping small institutions into one channel or the other and therefore becoming less competitive, unable to shop their loan among different players. So that's one of our primary concerns about its impact on the local institutions.
Mr. Skillern, you talk about something modeled more or less on the North Carolina Housing Finance Agency, that is a public purpose entity, and you note in your written testimony that you get rid of the conflicting private profit motive, which may have driven some of the practices in the GSEs that came back to haunt us. Does the idea of a lender co-op perhaps fit into that, or is this kind of a completely different structure?
I think it would be a different structure. In addition to my concern about access to capital for small financial institutions, I also have it for low to moderate income households and communities of color, and that the pricing of that risk and how we define the boundaries can be very narrow or more expansive as long as they're more responsible and sustainable. So I also think that the Housing Finance Agency model would be a smaller role to play. If you look at the total of what's really happening in North Carolina, it fits a particular range where there's an appropriate role for government to help facilitate home ownership and rental housing. So we really embrace this concept of both private and public participation, but that public has to be intentional. And I guess my concern about the cooperative model is that that's not intentional enough to assure us that we're going to have enough access to a range of communities across the country.
Do you see the government standing behind such a public purpose entity, such an independent nonprofit, if you will, that's playing this secondary market role?
Yes, sir, I do. I believe that while as much as we want to put taxpayer money behind private money, that we want to assign risk to the decision makers so that we're not putting taxpayers to insure someone else's moral hazard, the reality is that our government and our taxpayers stand behind our society as far as how the risk that we take and our cost. So there's a role for that, and I think we should be upfront about it, but also then be clear about defining what those limits are. And I think that this finance agency model allows us to define that more clearly to say who pays once private dollars are taken.
Thank you.
Mr. Skillern, in your testimony, you mentioned that the GSE loan level pricing adjustment policy and impacts on low to moderate income borrowers. This appears to be similar to what is being proposed in the qualified residential mortgage proposed rule. Loans with low down payments become less affordable as conventional loans and are forced into FHA. Can you explain this program to me and what lessons can be learned from it in regards to pricing loans according to the size of the down payment rather than the ability to pay?
To echo the comments of the bankers who feel like they have the ability to understand risk because they know their customer and to do the loan file review, the ability to repay is really the primary underwriting that we should have in approving loans. The loan level pricing program of the GSEs is essentially pricing much higher for loans that have down payments less than 10% and credit scores less than 720. And while we certainly applaud stringent underwriting, safe underwriting, the result, though, is that you start to add price to anything outside that narrow band. You push folks over to FHA, which has a bigger impact of more credit being more risk directly on the taxpayer as government guarantees FHA loans. Or you start to price people completely out of the home ownership market and deny them. And it starts to shrink who's able to purchase a home, particularly on the first-time home buyer. The QRM is similar in that it's even a greater definition. It's setting the benchmark at 20% down payment, further narrowing who eligible credit-worthy borrowers are. And as fellow bankers have said, there are a lot of good borrowers out there who don't necessarily have 10 or 20% down. And when you look at who in that category doesn't, it often tends to be low and moderate income households or community of colors who don't have that down payment or wealth to be able to meet that criteria. So part of our housing policy has to be based on sound economics, sound underwriting, protecting the taxpayer. It also should be done with some sense about how do we have social inclusion that allows credit across the spectrum of our communities. That's the intentionality that I referred to earlier. So we're opposed to the QRM because it draws that band of what's prime much too narrow and is not good for the housing market as a whole nor for the local communities.
When I look at the average income in North Carolina and I think about a 20% down payment, it appears that people would have to save upwards of 15 years plus in order to be able to afford a 20% down payment on an average house in North Carolina. And I just think that's definitely pricing people out of the market and unreasonable.